Well, Sarah, the fundamental drivers of demand for energy growth are a growing population, 7.5 billion people on the planet today, 9 billion people by 2040, and an ever rising quality of life for those billions of people around the world. And that takes energy of all forms. Light duty vehicle transportation is only about 10% of global greenhouse gas emissions. And so we need to find solutions to the other 90% in order to address the challenge on climate. For our industry, about a quarter of a barrel of gasoline ends up in light duty, or a quarter barrel of oil ends up in light duty transportation. The other three quarters ends up in ships, in aviation, in petrochemicals, in heavy duty long haul transport. And so electric vehicles are they're here today. There will be more in the future. There's no doubt it's growing off of a small base, but we anticipate by 2040 that there will be hundreds of millions of electric vehicles in the fleet. And we still forecast the demand for oil will grow over that period of time. So these are developments that are not new. They're trends that have been established, and they're part of our fundamental outlook for the future. Well, prices have rallied. We see markets that are healing. Demand is coming back as the pandemic is gradually becoming better controlled, and supply has been somewhat constrained by OPEC and OPEC Plus. So excess inventories are coming down, and prices reflect this gradual move back towards a more equilibrium state in markets. But we're not banking on higher prices for our business. The plans we laid out today for investors assumed a flat $50 price in nominal terms, so no inflation in there at all. And we committed to doubling return on capital employed at those kinds of prices and increasing free cash flow at a 10% compound annual growth rate. So we're prepared for prices to be lower than they are today. If they're higher, we certainly welcome that, but we're not counting on it. Well, I think the industry's been through a very difficult period of time. And you look at earnings last year, you look at write-offs and balance sheets that have taken on a lot of debt. Companies, there's a number that have had to cut their dividends. And so the industry has got some work to do to come out of that. We actually entered with the strongest balance sheet in the industry. We still have the strongest balance sheet. We didn't cut our dividend, and we're in a position where, with some of the changes we've made, I referred to earlier, we're in a position to lead out of this period of time. We're stronger for doing low in cycle acquisition last year of Noble Energy at a very opportune time to strengthen our asset base and our company. And we're growing free cash flow in a very strong position in an industry that has been through a lot. And so I think we're going to see only a gradual recovery, and certainly the prospects potentially of further consolidation over time. Well, I believe Chevron is a great long-term value investment for any investor. And so we certainly do welcome Berkshire Hathaway's investment in our company, and they're well known as a long-term investor, a value-oriented investor, and one that we're very pleased to have in our stock. We actually haven't had discussions with them to this point, and so I can't infer anything other than their investment decision would suggest that there's some confidence in the long-term future of our company and our ability to generate value for shareholders over the long term. And I look forward to meeting with them in the weeks and months to come.